Okay, we're going to try again. Let's go ahead and talk about early bond retirements. Now, firms may, for whatever reason, wish to buy their bonds back prior to maturity. Let's go ahead and look through several different examples using the same bond issue for all three. Nice short 3-year bond issue. So let's go ahead and assume that on January 1st, 2001, ABC Company issues $100,000 of 3% 12-year bonds. The bonds pay interest each December 31st, mature 12/31/03, and are sold for $104,973.70, a yield of 10%. Now you may wish to go ahead and just for the fun of it, go ahead and confirm that the present value of those cash flows discounted at 10% would in fact be $104,973.70. Again, give or take a small rounding error depending upon how you do it. We're going to use the effective interest method on all these. So let's go ahead and set up an amortization table. And again, reading across the columns, for each year, we start with a carrying value at the beginning of that year, multiply it by the effective interest rate, that gives us our interest expense, subtract out the cash interest, and the remainder is amortization. Now, when we retire bonds early, we're going to go through the same multiple step process. Step 1 is always going to be to bring interest and amortization up to date for the bonds that are being retired. Again, if the bonds last paid interest on December 31st, 2001, and we're retiring them in the middle of 2002, we need to go ahead and record the interest expense associated with having the bondholders' money for the 4 or 5 or 6 months that we've used it since we last paid interest. Next, we're going to remove the bonds being retired and all of their related accounts from the balance sheet. We're going to record the payment. Again, in this context, we're going to be paying cash to buy the bonds back. And the difference between what we pay and the net total of all the liabilities satisfied is going to be either a gain or a loss. If we pay more than book value, we'll have a loss. If we pay less than book value, we'll have a gain. Okay, let's go ahead and start with the simplest case of all, where all of the bonds are bought back on an interest payment date, or in this case, the day after. Let's go ahead and assume that all the bonds are bought back on January 1st, 2003 at 102 or 102% of face value and retired. Now, step 1 is not applicable here since we just recorded interest the day before. Now, if you're really picky about it, you could say, well, I want to go ahead and record interest and amortization for 1 day. That doesn't seem to be something that would pass the cost-benefit test. So we need to go ahead and take the bonds and the remaining premium off the balance sheet, record the payment of $102,000. So to refresh our memories, here's the amortization table. And we're looking at the 2003 line on the amortization table. Looking at the 2003 line, the carrying value at the beginning of 2003 was $101,818.18. $100,000 of face value plus an $1,818.18 premium. So we'll take the bonds payable off the balance sheet. We'll take the premium on bonds off the balance sheet. We'll record our cash payment of $102,000. And again, in this case, we paid $102,000 to satisfy $101,818 of liabilities, so we paid essentially an extra $180 some dollars. That excess that we paid is going to be a loss on retirement. Now let's go ahead and make it a little bit more complex by, instead of buying back all the bonds, let's just buy back a portion of the bonds. So let's go ahead and assume that on January 1st, 2002, we're going to buy back $40,000 of the bonds, 40%, for $39,000. And again, we don't need to bring the interest and amortization up to date since we just paid interest the day before. And there's our amortization table. And again, we're going to be looking at the 2002 line in our amortization table. Now at January 1st, 2002, there's a premium of $3,471.70. Since we're retiring 40% of the bonds, that means that 40% of that premium has to be eliminated. So we go ahead and get rid of the bonds payable. Again, step 1 not applicable. We don't have to bring interest and amortization up to date. So we're jump to step 2. Get the bonds payable off the balance sheet, $40,000 face value. Get the premium associated with those bonds off the balance sheet. And again, that's 40% of the January 1st, 2002 balance. We write our check for $39,000. And again, the difference is a gain or loss on retirement. Now, after doing this, our original amortization table isn't quite as useful as it used to be, because basically the amortization table up above shows interest and amortization for the entire bond issue. The entire bond issue no longer exists. Only 60% of the bond issue exists. And there are a couple ways we could do this. One, we could stick with our original amortization table and simply say, look, interest expense, cash interest, and amortization are going to be 60% of their prior levels. So the interest expense, the cash interest, and the amortization, we'll simply multiply those by 0.6. Alternatively, we could go ahead and update our table and say, look, at January 1st, 2002, there was a carrying value of $103,471.07. We got rid of 40% of that. So the new carrying value is only 60% of that, and basically recast our amortization table. And if you look at the amortization table that just popped up, the 2002 carrying value has been dropped to $62,082. That's 60% of the value in the previous amortization table. And we simply continue as we had done previously with constructing the amortization table. Again, obviously you have to change the cash interest. Now we're paying 12% of $60,000 as opposed to 12% of $100,000. Okay, let's go ahead and change it again. And we're going to go back to retiring all the bonds, but now we're going to do it between interest dates. And that means that step one of bringing interest and accruals up to date is now going to apply. So let's go ahead and assume that on April 1st, 2002, all of the bonds are retired or repurchased at 99 plus accrued interest and retired. Now, what is the accrued interest? Again, interest is computed as the face amount, the cash interest, the coupon interest, the accrued interest, is computed as the face amount of the debt times the interest rate times the time period. So we're accruing interest on $100,000 at 12% annually for 3/12 of the year. So $3,000 of interest would have accrued on these bonds. Now we're going to pay 99 plus accrued interest. So we're going to pay $99,000 for the bonds themselves, plus $3,000 for the accrued interest, a total of $102,000. Now you need to be careful when you read these problems to see how it's worded. Sometimes it'll say 99 plus accrued interest, sometimes it will say 99 including accrued interest. If this problem was written as 99 including accrued interest, that means the total cash payment would be $99,000. $3,000 of that would have been for accrued interest, only $96,000 would have been for the bonds themselves. Okay, so there's our amortization table again. And we need to go ahead and figure out how much interest needs to be recorded for the January, February, and March, bringing interest up to date. Interest expense, again, it's $10,347.11 for a full year. We want interest expense for January, February, and March, 3/12 of a year. So we take the full year amount, multiply by 3/12, and get $2,586.78. Similarly, with the coupon interest, it's $12,000 annually. We want the coupon interest for 3/12 of the year, $3,000. Again, that's the same amount we computed up at the top of this slide. Finally, the amortization, same drill. We take the full year's amortization of $1,652.89 and say we want amortization for 3/12 of a year, or $413.22. Let's go ahead and continue with this example. And again, just to refresh our memories, first thing we need to do is bring our interest and amortization up to date. We just computed the amounts on the previous slide, and now simply a matter of recording them. So we record our interest expense, we record our amortization, and we record our interest payable. And again, we're not actually going to pay that interest as a separate check. That interest payable is going to be satisfied by buying the bonds back. Now we need to get the bonds and related accounts off the balance sheet. Now there's only one thing that might be a little tricky here, and that's dealing with the premium. Most of these accounts are very straightforward. At the beginning of 2002, again, looking at the 2002 line on the amortization table, there was apparently a premium of $3,471.07 at January 1st, 2002. We just got finished amortizing $413.22 of that. That means that there's only $3,057.85 remaining. So we get the bonds payable off the balance sheet at face value. We get the remaining premium off the balance sheet. And we're also satisfying the interest payable. Again, we're going to buy these bonds back and run them through the shredder. We're never going to have to pay that interest payable after date. We're satisfying that obligation by buying the bonds back. We write our check for 99% of face value plus accrued interest, $102,000. And again, the difference is a gain or loss on retirement. And again, this is a point that seems to confuse people for some reason, so I want to reiterate this. Again, if you look at the carrying value at January 1st, 2002, the carrying value is $103,471.07. The bonds have a face value of $100,000. That means the premium must be the other $3,471.07 at that date. Okay, this is going to be the most complex of the cases. Let's go ahead and deal with a partial bond retirement between interest dates. So this means that in addition to doing the interest and amortization for a portion of the year, we also have to do the interest and amortization for a portion of the bonds. There's our amortization table again. And let's assume that on September 1st, 2002, 30% of the bonds are repurchased for $32,000 plus accrued interest. Now again, we only want to bring the interest and amortization up to date for the bonds that are being retired. The 70% that's not being retired, we're not going to touch those. We're not going to worry about those. We're only concerned with the portion that are being retired. Now again, looking at the 2002 line on the amortization table, interest expense for the year is $10,347.11. We don't want interest expense for a full year for all the bonds. We want interest expense for 8 months, January through August, for 30% of the bonds. So interest expense will be $10,347.11 times 8/12 to get the correct proportion of a year, times 0.3 to get the correct proportion of the bonds, so $2,069.42. Likewise with the coupon interest. It's $12,000 per year for all the bonds, so we want it for 8/12 of a year for 30% of the bonds. And likewise with the amortization. It's $1,652.89 for all the bonds for a whole year. We want it for 8/12 of a year for 30% of the bonds. So we go ahead and record that as, step 1, bringing interest and amortization up to date. And continuing the same example. Now we need to get all of the relevant accounts off the books. They're all going to be pretty easy, except for that premium, or discount as the case may be. And again, there's our amortization table. Okay, again, at January 1st, 2002, the discount was $3,471.07. We're retiring 30% of the bonds. That means that 30% of that premium has to be eliminated. 30% of $3,471.07 is $1,041.32. That has to go away. Now part of that we eliminated via the amortization just on the preceding slide. We amortized $330.58, which means there's still $710.74 that has to be eliminated. It's that remainder that we're going to write off as part of the repurchase/retirement. So we get rid of the bonds payable, again at face value, that's always the easy one. We get rid of the remaining premium associated with those bonds. Again, we're also satisfying the interest payable that was accrued as part of this process. We write our check for $32,000 plus accrued interest, $34,400, and again the difference is a gain or loss on retirement. In this case, a loss of $1,289.26.